Hi guys, welcome back to the channel. Today we're going to talk about the two biggest factors in asset allocation. Now, if you don't know what asset allocation is, let's start with that. Asset allocation is the breakdown of your portfolio into percentage of stocks, bonds, cash, or other short-term reserves, or other investments. Now, everybody's asset allocation is going to be different, and traditionally we've decided that the way you figure that out is A, how much time you have, and B, how much risk you can take. So the two key factors we're going to talk about are time horizon, risk tolerance. First one, time horizon. Time horizon is pretty simple, you guys. That's how many months, years, or in some cases decades you have until you're going to achieve your financial and investment goals. That being retiring early, being able to be financially responsible. Whatever your investment goals are, again, always individual. Now, traditionally, if you're young, most people would say, be 100% in stocks. You're not going to need that money for 40 years. You're 25. And that's pretty true, right? Because we know stocks have the most potential to make us the most money. What if you're 55 years old and you don't have anything saved for retirement and you realize one morning, oh my gosh, I'm going to retire in 10 years and I don't have anything? A lot of people will take extra risk even though they don't have much of a time horizon left to try to make up that money. And we're going to talk about why that can be very, very, very dangerous and detrimental to your portfolio. Obviously, as you get closer, most people would say you should be a little bit more conservative, have a little more bonds, because as you know, whatever your percentage you have in stocks. So if you're 100% in stocks, you guys, you could lose 50% of your portfolio. Now, has that happened? Not yet. There have been some times when our portfolios have gone down 30 and 40% in the short term, and it's pretty scary. Now, we did see a little blurb back in March where the stock market fell pretty fast and pretty hard. And if that scared you, then that's why we're going to talk about risk tolerance. Our second key factor in considering your asset allocation, you guys, is risk tolerance. This is your ability to tolerate risk. What does that mean? It means, can you sleep at night if your portfolio is losing money day after day after day? It's hard. We got a little picture of that back in March, right? March and April, we had the stock market drop about 37% in what seemed like a month. It was very fast. Now, that did recover pretty swiftly, and we're back to about where we were. But if you were one of those people that was concerned about the money you lost and you thought about selling, maybe you're not the person that should be 100% in stocks. Bonds are controversial. Right now, bonds are yielding 2% or less. You guys, they're not even really keeping up with inflation. So, as I've always said, bonds are not for making money. Bonds are for security. If you have some in bonds, it actually lessens the amount. So if I'm 100% stocks, I could theoretically lose up to 50%. But if I'm 80% stocks and 20% bonds, the most I could actually lose is 40%. Now, that's not to say that's going to happen. But if you're someone who really gets concerned when the stock market goes down and down and down, then maybe you need that buffer. Now, if you don't want to use bonds, you could put that money in cash. As we know, cash right now is yielding 0. It's horrible. But if that's what it takes to let you be able to sleep at night, knowing that even though your stocks are going down, you've got some money set aside in cash that's not going to go down because it's safe, right? Then maybe that's what you need to do. So let's talk about asset allocation and how it slides as we get older. So the two main reasons: time horizon, risk tolerance. Obviously, as your time horizon shortens, your risk tolerance is going down too, because you have less time to correct that, right? If the stock market drops 40% and you've only got 5 years left to make that back, you might not get it back. You might be in big trouble. So the way to buffer that is, as you get older, add a little bit more conservative assets, i.e. bonds, or maybe some more cash or other short terms. Some people would say gold, although I'm not particularly sold on that. Just my opinion. Hate me in the comments if you have to, but gold, you can't store bars of gold. And gold, if you look at how much it's appreciated over time, really doesn't make that much money. Okay, enough about that, sorry. But as I said, as you get older, you're going to have to take less risk, because there are a lot of people who, like I said, that 55-year-old I used in the example before, decides I got to catch up, so I'm going to go 100% stocks. Well, that's great, and he starts building his portfolio up, right? And then 3 months before he's going to retire, he's 64, we have another crash like we had in March. You guys, that could completely derail his retirement. He may have to work another 5 to 10 years to make that up. So having a little bit of a buffer from bonds or cash can be helpful. But we have to be honest with ourselves. So in time horizon, obviously your age is going to tell you a lot. If you say I'm 25 and I know I'm not going to retire until I at least have $3 million, let's say, well, maybe you can make that in by the time you're 45 and retire early. That'd be good. But let's just go on a normal timeline. So you're 25 and most people retire at 65, right? So that's 40 years. You have a long time. And actually, when you're young, you should be wanting the market to drop, because then you're buying more shares of that fund or that stock, and it's got more time to grow. Time is on your side. If your time horizon is short, it's the opposite. Time is against you. You don't have time to be aggressive like that. You have to have some safety there. Just like everything else in investing, this is an individual thing, right? I'm not telling you just because you're 55, you can't be 100% in stocks. If you can sleep with that risk and you're okay with it, then go for it. Because we know more stocks has more upside potential. But it's something to think about. The risk tolerance is important. That being said, if you're 25 years old and you were ready to sell because you saw your $20,000 go down to $5 back in March, maybe you need to consider adding a little bit of bonds just to make you feel better, or cash, whichever you choose. Again, something safer that can buffer a little bit of the storm. All right, you guys, I hope you got something out of this. If you did, do me a favor, drop me a like. If you're not already subscribed, you know the deal. Hit the red button, ring the bell, get notified when I make another video. All right, we'll see you. Thanks.